Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today we chat with Portfolio Manager Dan Kelley about founder-led companies and where he's seeing opportunities in the areas of AI and innovation. He discusses Founders Class Fund, which focuses on companies whose founders are still deeply involved in its daily operations. Dan highlights the appeal of founder-led companies, including those in the Mag 7, which are closely tied to secular trends. He also anticipates broader opportunities, particularly in cyclical-driven companies that have been cautious up until now. He adds, despite concerns of an economic slowdown, he identifies opportunities in consumer cyclicals and financials, where many companies are currently undervalued and offer promising long-term growth. Dan explains his excitement for the potential of generative AI, seeing it as a transformative technology with the ability to revolutionize daily life. But he adds the rapid growth in AI could cause some unsustainability in the long term. And while the fund is predominantly focused on the U.S. companies, it does have some international exposure, including Canada. This podcast was recorded on August 13th, 2024.
Hi, Dan. How are you?
Hi, Pamela. I'm doing great. Thank you for having me.
Great to have you join us here. So delighted to see you again. We'll invite everyone to send their questions in to you as well over the next half hour. I wonder if we begin with a little bit of a genesis question, how this fund, which is founder-led companies, came into an existence. I mean, you could put them into other categories too. Why did it make sense to have a fund for founder-led companies?
You know, Pamela, it's a great question. So we just came up on our 5-year anniversary of the Founders Class a few months ago. And it's pretty exciting to see it kind of grow and mature and to see the thesis effectively play out that we originally had, or the hypothesis, if you will. So back in 2016, I worked alongside Will Danoff and Joel Tillinghast as an analyst. Well, I was a portfolio manager on some smaller funds then, and I was an analyst prior to that. And what we, in a conference room one day, we were talking, and a lot of the companies I'd covered as an analyst happened to be founder-led.
Oh, really?
What we distinguished is that a lot of these companies tended to outperform the benchmark average over time, and they wanted to pursue that. We did a lot of investigative work. We did some studies, and we launched a pilot fund. And fast forward 5.5 years, and we've seen the thesis really get validated, in my opinion, through all different types of markets over the past few years. So a pandemic was thrown in there, and so it's been encouraging, and I couldn't be more excited about the next 5 years.
It's so fascinating. So the founders themselves have to, for you to invest in the company, have to still be leading the company or on the board. Just sort of define that for us.
Yes. So for the most part, the founders still have to be actively involved in the day-to-day activity of the company. So on the board, in a executive seat, or having tremendous influence via significant share ownership. They can, in a few instances, be family-led, where that founder's mentality that I'm really trying to harness is spanning generations, but that's usually the exception, and I can count on one or two hands how many of those are in the fund.
Right. Okay. And if said founder leaves or dies in some cases, but I mean, what do you do there? Do you have to shift course?
No, another good question. So what I do is I put it on a 1-year shot clock, where I see if that founder's mentality, that foundation that the founder created, with which I wanted to ultimately see through to hopefully alpha for my shareholders, I see if that's going to kind of continue, because you never want to be a forced seller in the market, Pamela. And so the last thing you want is to hear something happen with the founder. Usually it's two ways a founder exits. Things are going wrong for a while, and those are usually not in the fund, hopefully, or they pass away, or they have some sort of medical issue. And in the latter case, I think a lot of what that founder has created from a culture standpoint, from a vision standpoint, is still on the come, and I still want to be part of that. So if by chance that's not likely to permeate the next generation, the heir apparent, I will ultimately sell out of that company.
And I'm thinking about founder-led companies that all of us can kind of think. A lot of them are household names at this stage. A lot of them are Mag 7. They tend to be, at the moment, pretty stuck to secular trends, if that's fair. I mean, they're on sort of long-term trajectories of sometimes growthy companies. Is that what all founder-led companies are like? Are they clinging and actually creating the secular trends?
Well, I think those companies that often get referred to as the Mag 7 embody a lot of the positive attributes of founder-led companies. I think sometimes people think they're the only founder-led companies out there. And what gets me so excited about talking about this fund is this is really a diversified fund that is investing in founder-led companies across every sector. So right now, I think technology, for example, is in the 30-35% range of the fund. It is not the whole fund. Some of the themes from technology rhyme across other sectors, but this is really a diversified fund, Pamela.
Okay, no, that's really interesting to hear because it does sort of lead you to think about some of those. So let's talk about some of those. I wonder what you lean into a little bit right now. Tell us a little bit broadly about what's of interest to you, and then we might dig into the sectors themselves. But there is a very strong secular theme, but there's also I mean, we have this whole interest rate backdrop, macro rate story that we think is about to go through a cutting cycle. So the cyclical story is very much alive and well. How does that fit with the founders led companies?
Yes, I'm very excited about generative AI. I think it's going to be a transformative platform shift and change our everyday lives in many different ways that we don't even realize yet. But I think there are other exciting things going on right now. And generative AI was kind of the only game in town the past 18, 24 months. And now I think that we're on the cusp of a Fed easing cycle after having to really rein in inflation, go through one of the fastest and most aggressive tightening cycles of my investment career. The fact that we're on the cusp of an easing cycle, I think will allow this market to broaden out a little bit. And as you reference on the cyclical front, there are many founder-led companies that folks like myself didn't want to touch until we could really underwrite how much the economy was going to slow. And when you think about my process is finding names that will grow for a faster rate for longer than the market appreciates, and will ultimately, if they deliver on those earnings expectations, they'll get re-rated by the market over time. So where I'm finding the most value relative to that growth potential, Pamela, right now is more on that cyclical side of the barbell. So think about home builders, think about interest rate sensitive sectors, retailers, restaurants. There are a lot of exciting names that to me look very mispriced relative to that 3-year out, 4-year out earnings power that are effectively on sale right now. So I don't want to sell AI short, if you will, in terms of I think AI is here to stay, and you need to have some exposure to the new innovation that's going to come from AI. I just think now you can have a bit of a broader portfolio.
Okay, well, and we'll circle back to AI to dig in deeper about sort of where you think that goes and the types of legs that it's going to create that you want to invest in. But let's go into some of the sectors themselves. So biotech, we're within healthcare. At one point, that was a little bit left for dead. But again, the rate cycle changes a lot of that, doesn't it?
It totally does. So as I think about the 5+ years of managing this fund, in general, I would say liquidity and capital was leaving the biotech sector. You think about what happened during the pandemic. We had to create infrastructure for vaccines and tools, and biotech is losing money. It's betting on something very long duration that may or may not pan out. Oftentimes, lower probability events, and so capital was not going into the biotech sector. That didn't stop innovation. So you continue to see companies leverage some of this high performance computing power we just talked about to innovate. And so the beauty of those two things is a lot of the companies that I'm looking at that are effectively platforms So I don't want one shot on goal if I'm buying a biotech company. So one binary risk where if the data hits, it's a blockbuster, and if it misses, it's a zero. I don't want those. I want real innovation platforms. So when you think about some of the companies that are in this fund, in the top 10, we have a Regeneron, which is an antibody platform. They have multiple drugs. They're looking into oncology with some of their innovation, and they're leveraging mechanisms that have multiple shots on goal that I think allows the addressable market to be much bigger. So right now, I'm finding smaller companies in the biotech space that have multiple shots on goal, have these powerful platforms, and they're effectively on sale. And I think given what I just mentioned about where we are in the tightening cycle, you're starting to see liquidity slowly come back into the biotech sector. That means cost of capital for biotech companies will come down. A lot of that value will accrue to the innovative platforms, I think, from an equity cost of capital if they continue to deliver on that innovation.
I mean, you're sitting in the middle of it. You're in Boston, and also, I guess, the West Coast. But I mean, Boston's full of biotech companies that are. So actually, they're all led by founders, or obviously the ones that you're talking about. Are they doctors in most cases?
Yeah. So usually it's sometimes the chief scientific officer. So oftentimes the founder brought the IP to the company, and then you need kind of commercial folks to build it out. But in the case of Regeneron, the co-founder is the CEO still to this day. So it varies, but yeah, what's so exciting about biotech is there are a lot of founder-led companies. So there's a lot of names I can sift through, and luckily we have such great resources here at Fidelity with PhDs, neuroscientists helping me really distinguish where the true unique innovation is.
That's so fascinating. It'd just be fascinating to learn all that research. The consumer seems to be what everyone talks about right now, again, because of the backdrop, because of the macro story. We've been priced out of things. People are getting sick of paying higher prices. That said, there's sort of where are we in that cycle? Like, can you see the other side of that?
I can. I think there's a lot of fear in the marketplace right now because the economy has been slowing. The good news is it's still growing. So we just went through this incredible tightening cycle. The economy's still growing. Unemployment still has a 4%, low 4% handle. There's not a lot of excess slack in the economy. A lot of people that own assets have just seen those assets reprice up 40% or so if you own a home over the last few years. So the fear of this reflexive kind of downward spiral where people lose their jobs and they have to sell their house, they can't afford I just feel like there's so much net worth out there that it's really hard to have a bad credit cycle. You could have a slowing economy and layoffs can go up and unemployment could continue to drift higher. But that kind of reflexive down spiral, I don't see happening. And what's great for me is I underwrite stocks based on what's priced into them. And a lot of folks are concerned about that downward spiral. And so a lot of the companies that I'm looking multiple years out are really on sale. So in the consumer space and consumer cyclicals, some of the financials, I'm finding a lot of exciting ideas. And, there's some wallet share shift, Pamela, like, people might not travel as much, but, once interest rates kind of start to drift down, they might invest in their home a little bit more. And so there'll be some wallet share shift. I don't think we're off to the races. I think it's really kind of the expectations priced into some of these consumer cyclicals seem really draconian to me relative to what I think will play out over the next year or two, particularly if the Fed cuts a few times.
That's fascinating. You mentioned financials there within the sort of cyclical story. Which aspects of financials?
So one theme that's really powerful in the fund is alternative asset managers. So I think
these are the individuals, I guess. Again, these are the founders.
So yeah, founder-led companies in alternative asset management. So when you think about alternative asset managers, they used to be like a third rail conversation, like private equity and a lot of leverage and risk. Over the past few years, that asset class has really been institutionalized. there was a perception that illiquidity and lots of leverage was just always a negative. I think you've seen these companies, the ones I own that are founder-led, diversify across asset classes. So now they're not just in private equity, they're in private credit. They're senior in the capital structure. So if something goes wrong, they can help work out that company and take equity back. And sometimes the returns are even greater on the other side. And so what's happening right now is that asset class has been institutionalized. You're seeing retail investors kind of embrace the idea of having some diversification across private asset classes as well, and that's leading to tremendous capital flows to the best in breed companies that have been around for a while. And the ones I own in this fund have been around for quite a while, in some case multiple decades. They're unique individuals who think about the downside. They aren't levered to the gills, and they're really creating a lot of value in a risk-adjusted basis and makes sense in a lot of portfolios. So, and they're mispriced right now. So I think of Apollo is in my top 10, and Mark Rowan is a really special founder that I think harnesses this vision of further institutionalizing the asset class, and I think he'll hopefully deliver on that.
Do you meet all of the founders always?
The beauty about the access and scale of Fidelity is we do have access to these individuals, often way early in their life cycle, which is kind of what I'm trying to leverage to pick stocks for you, the shareholders, and find the right individuals, the right visions, combine it with my process to underwrite if they're mispriced on a multi-year basis. And so I would say I've met with virtual meetings have picked up, but I would say if you combine in-person and virtual meetings, I've definitely met with the majority of the founders and founder-led companies that I own in this fund.
Okay, amazing. So it's primarily North America. I know in the past you've invested in some Canadian companies. Are you looking further afield? Is there a global element to, again, this kind of macro backdrop? We've got interest rate differentials that are also creating some interesting pockets for some investors.
Yeah, so this is benchmarked to the Russell 3000, so predominantly a U.S. fund. I'm in the upper single digits in terms of international exposure outside the U.S. The beauty of the opportunity outside the U.S. is it's multiples of what it is in the U.S. in terms of meeting my founder-led definition. So we have about 700 companies to choose from that meet my definition from a founder-led, founder-involved, and liquidity standpoint. We have 2,000, 2,500 outside the U.S. And so as I've been doing this, running this mandate longer, I'm getting a chance to really stress test these international companies, get to meet the founders, as you mentioned. Underwrite, are they delivering on what they say they're going to do, and really kind of build that kind of trust and goodwill. And so you have seen that drift up in terms of the international exposure, but it's still relatively small.
Okay, really good to know. Just sort of see how you look at that ultimately. Okay, let's go to AI and ultimately the founders that are there that many of us know their names. Actually, I think you mentioned one of the founders was sort of the Picasso of our generation. I'll let you reiterate that, but let's just dive in here of what we've seen thus far and probably where it's going for you in terms of investment.
So yeah, Pamela, we're in the midst of a powerful build out of the infrastructure for what's called generative AI. So this is high performance compute data centers. I'm sure a lot of you have read about NVIDIA and Jensen. I think Wong was the person I mentioned, that's the Picasso of our generation, but he really saw kind of where the puck was going here and recognized that all of our existing data center infrastructure was really built for like a CPU world where it wasn't this high performance compute. We're going to have to make, millions of queries in a millisecond and get back to, get the answer back. And so what's happening right now is a lot of people think that we're in this air pocket or we've overbuilt from an infrastructure standpoint, because they're looking at NVIDIA and they're like, this growth, they're concerned that this growth is unsustainable because it's been just tremendous. I think what they're not appreciating is that this takes time. So what happens is you build these models, you're building new applications on this high performance compute. We've seen some of them as recently as Meta's earnings. Meta AI had is their search function that's seeing a lot more engagement. They have AI Studio, for example, where they're helping develop content for their customers from an advertising standpoint, and that's leading to higher performance of those ads. And so I think if I were just sitting at home reading the newspaper and not immersed in this technology, I would think, oh, wow, my life's not really changing much. And I'm hearing all this about generative AI, but this is going to take place over the next 5, 10, 15 years. And over time, after the infrastructure has been built out, you're going to see more kind of applications, whether it be a personal assistant or things that will make you more efficient at your everyday lives, things you're probably willing to pay for because they enhance your life. And it's my job to go out there and figure out what these applications are and see if there are companies, founder-led companies that really will be the next application layer for this new infrastructure layer. So if you think about the applications from the smartphone, you have, we use every day, Instagram, Uber, all these things. There'll be another application layer once we've kind of laid this foundation of infrastructure to actually utilize high performance compute. So that was a long-winded answer. I apologize.
Oh, no, it's so interesting though. I was just going to follow up with sort of those names and companies that you're talking about there. When you're going further afield and looking at other companies, are you looking at either AI companies in other countries, or is actually what's going on in the US just so far ahead that it's sort of not worth it?
We've seen some companies outside the U.S. kind of catch up from seeing the vision and trying to kind of replicate some of the aspects of what's happened in Silicon Valley. But when you think about the scale of these companies, how many billions of users Meta has, for example, every day, to roll out an application across that distribution base of customers can be really, really powerful. So there are tremendous scale advantages. The companies are, in some cases, they're part of this infrastructure build out. So their business is actually benefiting from this.
What's for instance, Matt, when you say they're building out?
So the cloud, the big cloud hyperscalers. So you think about like Microsoft and Alphabet and NVIDIA, like they're as we upgrade this data center infrastructure, they're actually the ones that you outsource your IT infrastructure. Well, not NVIDIA, but they're kind of playing it from a second derivative. And Amazon Web Services, they're the ones you're kind of outsourcing your tech infrastructure to, and they need to, at the back end, upgrade their infrastructure so that you're willing to pay more for this high performance compute that's helping you do all these things to make your business better. So it's kind of like this iterative, so that they're part of this toll taking infrastructure layer. And they generate obviously tremendous gobs of free cash flow, and they're unlevered. And so during this period of uncertainty on the economy and the high rates that are biting anyone with levered capital structures, and they've been able to kind of just keep forging ahead. So things have been well for these large scale U.S. companies relative to the rest of the world.
You ever get founders together? Do you have a dinner with whole bunch of founders or
occasionally? Yeah, it's a great question. Occasionally at like a conference or something. They're so busy. It's rare. There might be a big event in the industry where they're together, but it's back when I did real estate, going back to my history as an analyst, we would often get these billionaire founders together. And those were some of the best meetings where, they'd be going back and forth and disagreeing and agreeing on different things. And the insights you garner from those meetings were really special. And I miss some of those.
Yeah, no, it must have been absolutely fascinating. So when you just want to kind of come back to ultimately the fund shifting as the economy shifts and becomes a new economy in certain areas, and just sort of who you're who you're looking for now. You said like early in people's life cycle, like as people are innovating, do you have the ability to be meeting with founders that you think are going to be the next, Mag 7? Just talk a little bit about your hunting ground in that way.
Of course. So just to be clear, I think I've talked a little bit about the cyclical names that are exciting me right now. This is definitely a growth leaning fund, given kind of the mandate is the founder has to be involved, and generally older economy companies that have been around for 100 years typically don't have the founder involved. So this will always be a growth leaning fund, and I'm very excited about the long term from a growth perspective. So I'm equally excited about AI. I like the fact there's a little bit of diversification to new kind of mispriced opportunities, if you will. So my hunting ground is kind of across the whole market. I'm spending a little bit more time on the short term on the cyclical front because I think what's happened is the multiples of cyclical companies have really derated as the market's fearing that they're over earning. And if we do get a rate cutting cycle without a lot of economic demand destruction, I think you can get paid twice with both a re-rating of the multiple and then the earnings will follow through over the next few years.
That's fascinating. Yeah, because that makes me want to ask you where we are in the cycle, because it's even after last week, it just seems like it's hard to read, or it looks more like late cycle in a way, but then there's a lot of pieces that maybe aren't that way. So I'm kind of curious, what do you think?
It's a fantastic question. It's a complex one to answer. If I had to answer it in a soundbite, I would say we're kind of mid to late cycle. Typically, a rate cutting cycle, if we are embarking on it, is early cycle. And what I mean by that is earnings are very cyclically depressed because you've seen a lot of demand destruction and businesses were harmed by that. And then the liquidity comes into the market from an interest rate cutting cycle, and you see earnings really recover while the valuation also recovers. I would say we don't have the cyclically depressed earnings, but we have cyclically depressed multiples in some cases. And so I think as the Fed cuts, you could see kind of a reemergence of better earnings growth. And that's kind of, I'd say mid to late cycle.
Okay. Well, it's fantastic to speak with you. Who's the next founder that you're going to speak with?
Oh, geez, my calendar is loaded. So I don't know right now, but actually, I probably do know. Let me think. Earnings just wrapped up, so I've been doing a lot of follow-up calls. We did talk to Jensen recently. Who's the next founder? I think it's going to be one of these cyclical companies, so probably maybe in the housing industry, for example.
Fascinating. So interesting to hear, how companies are led as they were originally intended by the founders, and that you invest across that and how successful it's been. Thanks, Dan Kelley, for joining us on Fidelity Connects.
Thanks for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.